For the 9th straight Federal Reserve meeting, the Fed raised the federal funds rate. This can cool off inflation, but it also encourages people to save more money as interest rates on savings accounts or money market accounts becomes more juicy. Fidelity yet again raised their interest rate on their money market accounts. Uninvested cash in a brokerage account gets swept into Fidelity's money market funds called their core position. A core position is automatically started when you open a Fidelity account. There is no additional work on your end. Money market accounts are a type of savings account offered by Fidelity that gives a high interest rate and is SIPC insured in case Fidelity ever goes out of business. But I wouldn't worry too much about them going bankrupt anytime soon, as they manage $4.5 trillion in assets and have another $12 trillion in assets under administration. This is money that they are not actually managing, but it's money that people have in their brokerage accounts. Fidelity has 3 core positions that can be changed and adjusted whenever you want. Each of these stores your uninvested cash. The first one is called F-Cash because it probably causes some increased blood flow when you realize that you get a 2.44% interest rate in Fidelity's free credit balance account, and Fidelity is going to give you that money back whenever you ask for it. F-Cash is as safe as it gets, but these other 2 options are also super safe and offer even juicier options. The next core position is called SPAX, a Fidelity government money market fund, and they are currently paying a mouth-watering 4.49% interest rate. This is a taxable money market account that's going to invest in US government repurchase agreements and treasury debt. A repurchase agreement is sort of like if I had an Elon Musk action figure and I tried to sell it to my friend for $20 today, but we come to an agreement that I will buy it back from him at $22 tomorrow. So in this scenario, he gets the benefit of playing with a verified Elon Musk for a day, plus a whole $2 in interest, and I get the benefit of having some cash right away, a win-win situation for both. This is very similar to what the Federal Reserve does when they buy these securities from the bank, giving the bank some cash to use for a few days. Then when the time comes to buy the securities back, the bank pays the Federal Reserve a slightly higher price than they sold them for, including interest. You notice the risk ranking heat map is as low as it can possibly get? That's because US Treasuries are considered one of the safest investments out there, because they are backed by the good faith of the US government. The US government is not going to default on its obligations. They have this magical ability to always just print more money. Just keep in mind, if the government defaulted on its debt, we'd have bigger problems to worry about than you getting your interest payments from Fidelity. This is ideal for investors who want that steady income, who want to preserve their capital, and to have it liquid. The last core position is called Fidelity Treasury Money Market Fund, or FCFXX. And this is a taxable money market mutual fund investing in US Treasuries. It again is intended for the investor who wants current income and to preserve their capital and get liquidity in their money. FCFXX currently offers a slightly lower interest rate of 4.46%, and they also have a 42 basis points expense ratio. Interestingly enough, if we add the expense ratio to the money market account interest rate, we get almost the same exact percentage as the current federal funds rate. Now, this is money that I would normally be doing absolutely nothing with. It's uninvested cash, so I don't mind paying that expense ratio to get near risk-free returns for doing absolutely nothing. Now, there's very little difference between FCFXX and SPAX. I wouldn't worry too much about trying to find the best one. Now, I already know people are gonna be like,
oh my gosh, what an idiot. Inflation is like 10% these days. You're gonna be losing your purchasing power to inflation with money market accounts.
And trust me, we all know money market accounts are not gonna give you as high as a return as inflation. But I want you to tell me what other investments are out there that can give you this high of a return with this low of a risk. I'll be waiting in the comments for you to tell me, because I know you can't come up with a better answer. So are money market funds gonna make you rich? No, probably not. But it is a temporary place to park your money with very little risk and enjoy a solid return. It's really a short-term play. Money market fund interest rates are largely dependent on what the Federal Reserve does with interest rates, So if they continue to raise it, expect Fidelity to continue to raise their interest rates, and if the Fed lowers it, expect Fidelity to lower those juicy interest rates as well. This is why during the 2010s decade, savings accounts gave very little in interest since rates were near zero. Want to know how professionals play the stock market with interest rate news? Check out this recent video I just did on this topic. If you like this content, make sure you leave a like for the algorithm and comment below what you think of money market accounts. As always, my videos are found in podcast form under the Collect Cash podcast name. Check out the Patreon and the Dividend Discord for some great conversations, and I will buy, stash, and collect cash you later.